Welcome everyone, welcome to the channel. Today we'll be learning how to analyze stocks of Indian banks. And after learning this, you will be able to find investment opportunities in Indian banking sector under 5 minutes. Now these are very premium contents and I'm giving away for free. And all I want you to do is to like, comment and subscribe and share as much as possible. Now let's go to the basic. A basic thing. Every sector is fundamentally different. The way we compare banks, we cannot use that to compare pharmaceutical industry. The way we compare pharmaceutical companies, we cannot use it to compare the FMCG industry. So it's very essential to understand the working model of banks. And how does bank work? Well, it's a very clever way how the bank work. Let's see. The investors deposited their money. Let's say it's 100 rupees. And out of this 100 rupees, 20 rupees the bank keep as reserve in case if there's an emergency they can quickly return it back to the investors, and the rest 80 rupees they give it for lending. And lending means of course giving away loans. And when we take loans, what do? We pay back to the banks as EMI with high interest, and that's how the bank makes profit. They pay back to the investors with interest, and the difference between these two interests is their profit. And if you think about it, the bank is making money with our money. That's why I said the working model of bank is quite clever. Now, why analyzing the banking sector? There are three magic words. One is balance, growth, and risk. Only if you can find the balance between growth and risk, you can find a perfect investment opportunities in banking sector. What's the point of growing by keeping or putting your company into risk? And that's exactly what's shown over here. Look at it. They have achieved the growth, but with high risk. A small tumble or fumble, everything will be ashes. So to find an investment opportunity, what we should do, we should find the balance between growth and risk. So the question will come, is there any easy way to find this balance? Of course there are. And it's called the financial ratios. And some of you have heard about it. And there are ton different of financial ratios: profitability ratios, efficiency ratio, asset usage ratio, working capital ratio, liquidity ratio. There are like ton of ratios, but we'll be focusing on very few ratio that is very critical in analyzing a banking sector. Now these ratios we will be analyzing today is advanced deposit ratio, equity multiplier, return on asset, return on equity, and we'll study what are these things one by one. So what is advanced deposit ratio? Advance is anything that the bank gives away. And what does majority of the time what does the bank give away? They give away a loan. And it can also be called the loan to deposit ratio, and it's a ratio between the loans given to the deposit received. And a safe way to analyze A by D ratio or the advance to deposit ratio is that it should be less than 1. It should always be less than 1. If it's greater than 1, that means they are in risk. Now the second ratio, it's not it's an equity multiplier. It's a leverage ratio, and this is a very important concept, and most of the people doesn't know about this. Fundamentally they don't know about this. So let's understand what is this. Supposing there is a bank and it's buying out assets, and how do they manage or buy their asset or build their asset? And that thing we can understand by the equity multiplier. Just look at these two. You can see these are the total assets and this is the total equity. And we know only a small portion of the total equity, the total asset is the total equity. That means what? That means rest all the portion how they build up their asset is by debt. And if you look at the second one, you can understand this is the total asset of the bank. but majority chunk of the total asset have been maintained or built up by the total equity. That means they are in less debt. So tell me which one is better. Of course, this one is better. A company with less debt, which can raise asset and total asset, which can raise asset and build asset, this will be better. And how do we find the equity multiplier? It's nothing but total asset by total shareholders equity. There's another formula. This will be an easy formula to find out. Equity multiplier equals 1 by 1 minus debt ratio. And how do we find the debt ratio? It's nothing but total debt by total assets. And most of the time in the balance sheet or in many of the sites, they don't give this equity multiplier. So we have to find this. So debt ratio, total debt by total asset, how can we find it? We can find the total debt from the balance sheet. We can find the total asset from the balance sheet, put it in this equation, and we will get it. And in an ideal situation, the equity multiplier of banks should be less than 15. It should be of maximum of 15. It shouldn't go beyond 15. If it goes beyond 15, it means the bank is risking their business. The next one is return on asset. Perhaps you have heard about it. But let's fundamentally understand what is return of asset. Just look at this formula. Net income by total asset. So what does it mean? It means how much by using total asset, how much net income do they make? Repeating it, by using the total asset the bank have, how much income do they generate? It's called return on asset. Now what does this signify indirectly? It signifies the efficiency of the management on using their total asset. So now you understand why return on asset is a very important parameter, because it gives out the efficiency of the management, it gives how good the assets are. Now, as a rule of thumb, return on asset on Indian banks should be greater than 1, then it should be considered attractive. Now, the second one, I know some of people have heard about it, return on equity. Just look at the formula and tell me how. Return on equity means by using shareholders' equity, how much net income are they generating? I repeat, by using shareholders' equity, how much net income are they generating? That means the efficiency of the management of turning shareholders equity. So this is a very important parameter, and it should be a minimum of 15 percentage. Anything above 15 percentage of ROE in the Indian banking sector, we can shortlist them for investment. Now, there's one thing I haven't included in our ratio slide, and this is called net interest margin. And this is a very important concept. That's why I wanted you to tell this thing at last. Net interest margin is a profitability ratio that calculate how much money an investment firm or bank is making on its investing opportunities. If you remember during the first slides, I told you what are the investing operations of a bank. The investing operations of a bank are nothing but loans. That's the majority of the investing operations of a bank. So the net interest margin is nothing but the interest received by bank from the loan takers minus the interest paid by banks to the depositors divided by the average invested assets. Now, this is a very important concept, because if you look at it, you want the NIM to increase. It's called NIM. If you look at it, you want the NIM to increase. But tell me, which one is more important for banks, higher NIM or higher ROA? If you ask this question even to some of the very layman banker or the fundamental analysis, they would say we need a higher NIM. But that's not the case. A NIM, when a bank focus only on increasing NIM, they end up issuing too many loans in an attempt to disperse more loans. The end effect is more NPAs or bad loans. So, not only the NIM should increase, the ROA should increase, and the threshold limit of NIM should be less than 4 in an ideal situation. The threshold limit of NIM should be less than 4 and it should increase till 4, or the NIM should be under 4 and the higher ROA should also increase. Now, these are the very major things you have to analyze when you're analyzing the fundamentals of Indian banking stock. Now, I'll give you a hands-on experience on how to shortlist stock by using the things we have studied till now.